Hello friends, in this lecture we will continue with the topic of admission of a partner. And in this chapter we were discussing about goodwill. That what is goodwill, why we are studying goodwill in this chapter, that is admission of a partner. What is goodwill? Goodwill is reputation. Why we are studying goodwill in the admission of a partner? Because the new partner who is joining the firm is going to enjoy the reputation, is going to enjoy the goodwill that has been earned by the old partners over a period of time. For that, the new partner must compensate the old partners by paying premium for goodwill. Right? Then we discussed the various ways in which the premium for goodwill can be paid by the new partner. One is privately. Then there is no record to be done in the books. Second, to be paid in cash and retained in business. Right? Then the premium for goodwill will be brought in cash, and that premium for goodwill will be adjusted through the partners' capital accounts. Why through partners' capital accounts? Because as per accounting standard 26, it is not to be shown in the balance sheet of the firm. Therefore, it has to be adjusted through the partners' capital accounts. Third case we did was that the premium for goodwill is brought in kind. Kind means asset. Similar treatment as cash. The only difference is instead of cash we will take assets. Right? This is what we have discussed so far. Now we move on to case 4. What is case 4? That the premium for goodwill is brought in cash. You will say that this is the similar case to case 2, but no, there is a difference. In the case 2, I told you the premium for goodwill is brought in cash and retained in business. This is the important thing here. See the difference now. Here I will say the premium for goodwill is brought in cash and withdrawn by old partners. Now this premium which has been brought in the business, which has been paid by the new partner to the old partners, this is not retained in the business. The old partners, after getting this premium for the new partner, they withdraw that money from the business. Now see, first we will do the journal entries for this first part, that the premium for goodwill is brought in cash. What is the journal entry? Cash account debit to premium for goodwill account. Clear? Now this premium for goodwill we will adjust through partners' capital accounts, because this premium is being brought into the business first, then it is withdrawn by the old partners. Right? I will say premium for goodwill account debit to old partners. In which ratio? Now if you have gone through the previous lectures, you can easily tell me in which ratio this premium for goodwill will be adjusted through partners' capital accounts. In sacrificing ratio. Right? What is the sacrificing ratio? Old share minus new share. This is the sacrifice. Clear? Now the point comes, it says it is withdrawn by the old partners. Here the premium for goodwill is brought in business. It is adjusted through partners' capital accounts. Partners' capital accounts are credited. Now if this money is withdrawn by the old partners, what will be the journal entry? First of all, we will debit the old partners' capital accounts, because they are withdrawing money. Here we were crediting the money to the old partners. Now if they are withdrawing from the business, we will debit the old partners' capital accounts. Then to cash or bank account. Simple. Half of the treatment is same, that the premium for goodwill is brought in cash. The only new thing is that it is not retained in the business this time. This has been withdrawn from the business by the old partners. Then simply we will debit the old partners' capital accounts and we will credit the cash or bank account. Clear? So let's see a practical problem on this. Strong and weak are partners sharing profits and losses in the ratio of 2:3. On 1st of April 2016, they admit Abel into partnership for 1/4 share in profits. Abel brought in 1 lakh for his capital and 36,000 as premium for his 1/4 share in the profits. The new profit sharing ratio of Strong, Weak and Abel is agreed to be 3:3:2. Strong and Weak withdraw the premium money from the business. Pass the necessary journal entries. Very simple. Friends, you can pause the video and you can try on your own. This is a very simple example. Let's see. First of all, let's write down the facts. There are two partners, Strong and Weak. They are sharing profits in the ratio of, in which ratio? 2:3. So the ratio is 2:3. The new partner, Abel, for how much share? For 1/4 share. What is the new profit sharing ratio? What is the new profit sharing ratio? It is 3:3:2. Okay, let's write down. So in the previous lectures I told you what will be the first step. The first step will be the calculation of sacrificing ratio. Right? So how to calculate sacrifice ratio? Sacrifice is equal to old share minus new share. Right? So now for Strong, what is Strong sacrifice? What is the old share? 2/5. What is the new share? 3/8. So this comes to 1/40. Now for Weak, what is the old share? 3/5. New share 3/8. This comes to 9/40. So what is the sacrificing ratio? So the sacrificing ratio turns out to be 1:9. Right? Now you can easily pass the journal entries. First of all, is he bringing some capital? Yes, 1 lakh as capital and 36,000 as premium for goodwill. What will be the journal entry? Cash account debit to capital account to premium for goodwill account. How much is the capital? 1 lakh. How much is premium for goodwill? 36,000. What is the total amount? 1,36,000. Right? Now this premium for goodwill will be adjusted through the old partners capital accounts. Who are the old partners? Strong and weak. Strong account debit to, here you will write strong capital account, weak capital account, sorry, not debit, credit. What is the premium for goodwill? 36,000. What is the sacrificing ratio? 1:9. So strong will get 3,600 and he will get 32,400. Right? Now read the last line of the question. It says that strong and weak withdraw the money from the business. Now if they are withdrawing the money from this business, which money they are withdrawing? This money they are withdrawing from the business. What will be the journal entry? We will just reverse their capital accounts. We'll say strong capital account debit, weak capital account debit with amount 3,600 and 32,400 to bank account. This 36,000 which was brought in by the new partner has been withdrawn from the business by the old partners. Clear? Now friends, there is one more thing in this question. It is not necessary that the old partners will withdraw the full amount. Full amount means 3,600 and 32,400. They may withdraw some part of the amount. Right? Now, write down here, note. In the above question, assume that the old partners withdraw only half the sum. That means old partners are withdrawing only half of what they are getting. That means they are withdrawing only half of this 3,600 and half of this 32,400. So what will be the journal entry then? The entry will remain the same. What will be the entry? Strong capital account debit, weak capital account debit to bank. Now what will be the amount? They were credited with 3,600 and 32,400. The question says that they withdraw only half the sum. So half the sum, half of 3,600 will be 1,800, right? Because they are withdrawing only half the sum, and the half of 32,400 will be 16,200. So what will be the total amount? 16,200 plus 1,800. This comes to 18,000. Right? So it is not necessary that the old partners will withdraw whole of the money. They may withdraw part of the money. In that case, we will take only part money in this entry, right? We will take that amount which has been withdrawn by the old partners. Be careful with this case in the questions, right? In the question it may be given that they withdraw only half of the money or some part of the money. It will be mentioned in the question. If it is not mentioned, that means they are withdrawing whole of the money from the bank, right? So this is the case where the amount brought in by the new partner, is withdrawn by the old partners, right? So friends, in the next lecture, this is all for this lecture. In the next lecture, we'll take up case number 5, where only part of goodwill is brought in by a new partner, right? A new partner who is to bring in the goodwill, he brings only a part of his share. If he is to bring 50,000 as premium for goodwill, he brings only 20,000 or either 25,000. What to do with the remaining amount? We have to recover that remaining amount from the new partner only. He is bound to pay that 50,000, but at the moment he is bringing only a part of that goodwill. He is not able to bring the whole of goodwill. This we will discuss in the next lecture, right? Thank you, friends.